A hard Brexit has already been priced in. Lucas dos Santos, BMI Research. The UK triggered Article 50 on Wednesday, formally starting the Brexit negotiation period. What have the implications on the pound been, and what do you expect to see in the coming months?
Well, the triggering of Article 50 this week didn't really provide any real new information for the markets. The date was flagged up well in advance, and also the UK government's willingness or apparent willingness to go for a hard Brexit has also been well flagged up since around January. So we don't really see too many near-term implications for the pound just from the act itself of triggering Article 50. From a broader perspective, we do believe that the pound has most likely bottomed. There's so much news priced in already. As I said, everyone knew Article 50 was coming. Hard Brexit is increasingly priced in. So there's a lot of bad news already priced into the pound that we do think it can quite gradually appreciate from moving forward. Valuations are historically cheap, for example. We think that's going to be one draw for the currency. So what kind of new information might come up that could influence the trajectory of the pound one way or another? Obviously, the economy, we have finally started to see some signs that growth is deteriorating. The UK economy was obviously quite resilient since the Brexit referendum, but now we're starting to see some downturns in the consumer sector, the services sector, which is previously what had been propping up the economy. And so, if this were to deteriorate beyond, expectations at present, I think consensus has UK growth around 1.6. In 2017, we're slightly below that. So if data were to start getting a lot worse, obviously that could impact the pound via expectations for monetary policy. The Bank of England seems happy to just sit tight, not do much with monetary policy. We're not forecasting a first rate hike until early 2019. Markets seem to be a little bit more hawkish. I think market implied hike is maybe coming in late 2018. So we're looking to see if there's any movement on that as more economic data comes in.
The US dollar has been on a steady decline recently as faith in Trump seems to be waning. What do you make of the US dollar's week, and what do you expect to see next?
Well, since Donald Trump's election in November, as a research house here at BMI, we have actually been quite below consensus in terms of growth, interest rate hikes, and this largely stems from the fact that we did not believe that Trump would be able to enact a lot of these pro-growth policies that the market was expecting in a timely fashion. And this played out quite clearly with the failure to pass healthcare reform. There's increasing schisms within the Republican Party right now, with Trump going after the quote-unquote Freedom Caucus. And so what's up next on the agenda, which is tax reform, and potentially after that infrastructure spending, we do see significant hurdles to getting that done. And if they do get done, we think they're going to kind of underperform some of the market's lofty expectations from earlier in the year. So this obviously has implications for the dollar. We don't expect another surge in the dollar, but of course you have to be selective. The dollar can probably appreciate against certain currencies, particularly some emerging markets. We're still forecasting the euro to remain on a broadly weak trajectory, largely because of kind of the still divergent monetary policy trajectories between the U.S. and the eurozone. And I'll just say one more thing, which is that even if Trump were to not really pass all these pro-growth policies, the underlying U.S. economy is still chugging along at quite a healthy clip. The economy is still healthy enough to warrant another rate hike this year and next year. So again, there are going to be persistent tailwinds for the dollar despite the political noise.
Emerging markets have had an especially good March. Do you expect this trend to continue?
Yeah, well, broadly speaking, emerging markets do appear to be in kind of a cyclical upswing. A lot of the countries that were hardest hit in the recent years by commodity prices and other things such as Russia, Brazil are kind of slowly turning a corner. But obviously there's a lot of variation among emerging markets globally. Some of our top picks in terms of the growth outlook, we quite like places like India, Indonesia, Poland, even Argentina and Latin America. So we do think, at least in terms of economic data, there is room for further improvement among emerging markets. The only thing we'd kind of highlight as points of caution are the fact that the renewed China stimulus efforts, largely credit-driven, are a significant factor driving this uptick in both commodity prices and wider, emerging market momentum. And obviously that's always in China quite somewhat of a tenuous situation given the rising imbalances regarding public and private debt there. And as always in emerging markets, there's going to be a high level of idiosyncratic political risks. So we saw this quite dramatically this week in South Africa with the rand down something like 9% after the cabinet was fired. Turkey is another area where there's going to be significant political headwinds. And then bring it all back to the United States, a failure for the U.S. to really push any infrastructure spending would also have some implications on commodity prices and potentially some dampen the outlook somewhat for emerging markets.
Thank you, Lucas, as always, for your expert views. I'm Jack Everett, and this was The Weekly Wrap. We'll be back on Monday for the week ahead.